Imagine a company with a billion-dollar war chest and a potential blockbuster drug really poised to redefine a whole medical field.
Yeah, sounds great.
And it's a big but, they're also facing intense competition and, significant risks.
Right.
So is this a game changer or just a really high-stakes gamble? That's basically the question we're trying to answer for you today.
Okay.
And actually, on that note, we will be covering the upcoming Q3 2025 earnings for this exact stock. Expected around October 30th, 2025. We'll have it within minutes of release, so you'll want to stay tuned for that one.
Definitely.
Welcome, everyone, to the Deep Dive. Today, we are, diving deep into Agios Pharmaceuticals, Inc., that's NASDAQ, ticker AGIO. They're right at the forefront of rare disease treatment.
And our mission here, as always, is to take all this complex information, from the research reports we've studied and really distill it down into the most important insights for you. We want to help you understand not just what the facts are, but maybe more importantly, why they actually matter to the bigger picture. Think of it like your shortcut to being genuinely well-informed on this company.
Exactly, a shortcut. I like that. And just for context, all our insights are coming directly from a comprehensive stock research report, other expert sources too, all current as of August 8th, 2025.
Right.
And when we last checked, the share price was sitting at $37.06. That was as of August 7th, 2025. Okay, so let's unpack this journey. We'll start with Chapter 1, Business Understanding.
Do it.
The report kicks off with this really compelling question, kind of sets the stage perfectly. It asks, with a war chest of over $1 billion and a potential blockbuster drug on the cusp of new approvals, is Agios Pharmaceuticals poised to become a leader in rare blood disorders? Or is it burning through its one-time windfall in a race against formidable gene therapy competitors?
No. Yeah, that frames it well.
Doesn't it? This isn't just, any old biotech story. It's about a massive strategic transformation. Founded back in 2008, Agios originally did both oncology and rare diseases. But then came the really pivotal move. In 2021, they divested their entire oncology business to Servier. We're talking up to $2 billion cash plus royalties down the line.
Huge deal.
Huge. And this wasn't just selling off a division. It was a deliberate, really bold play. It totally transformed Agios into what they call a pure play company, focused only on rare, genetically defined hemolytic anemias.
Right, narrowing the focus.
Exactly. And critically, that massive pile of cash, they didn't just hand it back to shareholders. Nope, it became their foundational capital. So Agios could suddenly operate like this really well-funded, late-stage startup, completely sidestepping the need for, dilutive equity financing that plagues so many biotechs.
Yeah, that's a really unique position to be in. Very different path.
It really is.
So their main moneymaker right now, their primary revenue, it comes from sales of their flagship drug, PRUKND. The generic name is Mitapivat. They sell that to specialty distributors and pharmacies.
Okay.
But they've also had this other pretty significant income stream, non-recurring milestone, and royalty payments from those oncology assets they sold off.
The gift that keeps on giving.
Exactly. I mean, prime example.
Yeah.
They got a massive $1.1 billion just in 2024. That came from Servier and Royalty Pharma, and it was tied directly to the FDA approval of vorasidenib, which was originally an Agios drug developed in their labs.
Wow. So their past success is literally funding their future focus.
You got it. It's a pretty neat financial springboard.
So PYRUKND, that really is the crown jewel here, isn't it? Tell us a bit more about it.
Yeah, it absolutely is. It's what they call a first-in-class oral disease-modifying therapy. Basically, it's designed to improve red blood cell health.
Okay, oral therapy. That sounds convenient.
It is. And it's currently approved in the U.S., the EU, and Great Britain for treating hemolytic anemia in adults who have pyruvate kinase deficiency, or PK deficiency.
PK deficiency, okay.
And importantly, in that specific, very rare condition, it really holds a monopoly position. It's the first and only approved therapy that actually addresses the underlying cause of the disease.
Mobley, okay.
Right.
But that's a pretty rare disease, right? So where does the real growth potential come from?
Good question. That's the whole strategy. The company's future growth engine really hinges on expanding PYRQKND into much, much larger patient populations.
Right.
So first up, they have what's called a supplemental new drug application, an SNDA, that's currently under review by the FDA. This is for thalassemia.
Okay, thalassemia. Bigger market. Much
bigger. And they have a PDUFA goal date. That's basically the FDA's deadline to make a decision set for September 7, 2025. So very soon. And it's actually already approved for thalassemia in Saudi Arabia, which is interesting.
Okay, September 7th. That's a key date. What else?
Then there's sickle cell disease, or SCD. Now that represents their largest potential market by far. They're expecting top-line results from their big phase 3 trial called RISE-UP by the end of this year, 2025.
End of 2025 for sickle cell data, and a launch maybe 2026.
Potential U.S. launch in 2026, exactly, if all goes well.
Yeah.
Beyond PYRUKYND, they do have an early-stage pipeline, too. There's tebapivat, which is meant to be a more potent PK activator, and another drug, AG236. That one's an siRNA therapy, sort of a cutting-edge gene-silencing approach that they actually licensed in from Alumni.
Okay, so multiple shots on goal, but PYRUKYND expansion is the main event. So it sounds like on one hand, they're this pioneer in PK activation, but as they move into these bigger diseases, they become more of a challenger.
Yeah.
How do you describe their market position and like their value proposition overall?
Yeah, you've hit on a really crucial point there. That in the specific field of PK activation, Agios is, well, the undisputed pioneer, no question. For PK deficiency, as we said, monopoly. But yes, for thalassemia and sickle cell disease, these much larger, already crowded markets, they absolutely become an innovative challenger.
So what's their pitch? What makes them stand out?
Their primary value proposition really is offering a convenient oral disease-modifying therapy, something that targets the fundamental cause of these diseases.
The convenience factor again.
Exactly. That convenience offers a potentially significant quality of life improvement compared to, say, lifelong blood transfusions, which are burdensome, or these incredibly complex hospital-based gene therapies. That simple daily pill aspect is key.
Makes sense. Patients probably appreciate that simplicity. Now, looking at the wider industry, biotechnology is just booming.
Absolutely exploding. The numbers are staggering. Valued at $1.55 trillion in 2024, and it's projected to shoot up to over $5.7 trillion by 2034. That's a compound annual growth rate of nearly 14%.
Wow, what's driving that?
It's fueled by breakthroughs in genomics, personalized medicine, AI, all the cutting-edge stuff. And within biotech, the rare disease sector is particularly attractive for companies.
Why is that?
Well, there are government incentives like the Orphan Drug Act here in the U.S. That often allows for premium pricing. Plus, there's just this huge unmet need. Something like 95% of rare diseases still don't have an FDA-approved treatment.
95%. Incredible. So how big are the markets Agios is actually targeting?
Right, let's break that down. PK deficiency, the current approval, that's ultra rare. Maybe 3,000 to 8,000 patients total in the U.S. and Europe. It's a global market under $1 billion, growing steadily around 7% a year.
Okay, small but a starting point.
Exactly. Then thalassemia, much larger. Already an $850 million market in 2023, projected to hit nearly $1.5 billion by 2030, growing a bit faster, around 7.8% annually.
Getting bigger, and sickle cell.
That's the real prize, the largest target. That market was already $2.76 billion back in 2023, and it's projected to just explode, really, to over $7.4 billion by 2030, growing super fast, nearly 16% CAGR.
Okay, so huge potential in sickle cell, but I imagine the competition there is intense.
You imagined right. While PYRUKYND has no direct competitors in PK deficiency for thalassemia and SCD, the landscape is, well, highly competitive, very crowded.
Who are the main threats?
The most formidable ones, arguably, are the one-time gene therapies. You got Bluebird Bio's Zynteglo, and then Casgevy, which is from Vertex and CRISPR Therapeutics. These offer, curative potential, which is obviously a huge draw.
A one-time cure versus a daily pill. That's a tough comparison.
It absolutely is. Beyond those, you've got the existing standard of care treatments. And importantly, there's also direct competition in the PK activator space itself. Novo Nordisk has itavopivat. They bought that from Forma Therapeutics. It's in late-stage trials for SCD right now.
Itavopivat. Any advantages there?
Potentially. It might offer once-daily dosing compared to PYRUKYND, which is twice daily, so that could be a competitive edge if it proves out.
Okay, tough competition. But the regulatory environment, you mentioned the Orphan Drug Act, that helps them out, right? Provides some advantages.
It does. That act gives powerful incentives, tax credits, waivers on FDA fees, and importantly, 7 years of market exclusivity once a drug is approved for an orphan indication.
It's 7 years exclusivity. That's valuable.
Hugely valuable. And Agios is clearly leveraging these things. They use expedited programs like we see with that upcoming PDUFA date for thalassemia. And you also have to consider the barriers to entry in this space. They're substantial.
Like what?
Well, the sheer cost of R&D is enormous. You need highly specialized scientific expertise, and Agios' deep knowledge of cellular metabolism. That really is a kind of scientific moat for them. Plus, you need robust IP protection, complex clinical trial logistics. It's not easy for just anyone to jump in.
So those barriers actually become their competitive advantages in a way.
Exactly. Those barriers directly contribute to their strengths.
Yeah.
Their pioneering scientific leadership in cellular metabolism
Yeah.
is a massive asset.
Mm.
They're not followers here. They're leading the science. They also have that significant first-mover advantage, being the first and only approved PK activator. That means they already have tons of clinical data, real-world evidence is building up, and they've established relationships with doctors treating these conditions.
And the oral therapy aspect, how big an advantage is that really?
I think it's crucial. Maybe their most critical differentiator, especially when you compare it to those gene therapies, the sheer power of an oral therapy, the convenience of a daily pill. It contrasts so sharply with gene therapies. Those involve multiple steps, lengthy hospital stays, significant risks, huge costs.
Yeah, sounds daunting.
It is. So for many patients and doctors, that simple, convenient oral pill is a huge draw. It's a really critical factor when people are deciding on treatment options.
That makes perfect sense. Okay, we've got a good handle on the business side, and now let's pivot and look at the people steering the ship. Time for Chapter 2, Management Evaluation.
All right, and this is clearly a team that's been strategically put together.
How so?
Well, look at the timing. Brian Goff became CEO in August 2022. He brings over 30 years in biopharma, the last decade specifically in global rare disease leadership roles at big names like Alexion, Baxalta. He was apparently a key driver behind significant growth at Baxalta, even named Mentor of the Year somewhere.
Okay, experienced rare disease guy.
Exactly. Then, right after him, Cecilia Jones was appointed CFO in September 2022. Again, over 20 years financial experience, also heavily focused on biopharma rare diseases, places like Biogen, Logic Bio. She's got strong M&A assessment experience too.
So CEO and CFO, both with deep rare disease experience, appointed back-to-back right after that big oncology sale. That feels intentional.
Oh, absolutely. The report calls it a clear and deliberate signal from the board, like a strategic installation of leadership specifically designed to execute this critical commercialization phase for Pyrukynd.
A pivot in human capital to match the business pivot.
You nailed it. They brought in the execution team for the new strategy. And how do they handle bumps in the road? Well, we saw an example in early August 2025. The stock took a dive after an analyst note highlighted some patient deaths found in an FDA database.
Ouch. How did they respond?
Pretty swiftly, actually. Agios came out and clarified that these events, while tragic, didn't actually change the known benefit-risk profile of the drug. That helped the stock recover. Generally, their communication and earnings calls seems transparent. They give clear updates on trials and strategy. They seem committed to ethical standards.
Okay, let's talk about money allocation. Their capital strategy seems laser-focused, right? Reinvesting everything back into the rare disease business.
Completely. You see it in the numbers. Q2 2025 R&D expenses shot up to nearly $92 million. SG&A, that's sales, general, admin, costs up to almost $46 million. That money is directly funding those big pivotal trials and building out the commercial infrastructure they need to sell PYU-KYND if it gets approved in wider indications.
And their M&A strategy is, well, kind of backwards, isn't it? They're sellers, not buyers.
It's definitely unconventional for a company this size, but also very smart, arguably. Instead of buying other companies, their biggest transactions have been selling their own assets, first the whole oncology unit to Servier, then selling off the future royalty rights for vorasidenib to Royalty Pharma.
And those deals brought in how much?
Nearly $3 billion in non-dilutive financing. That's the key. Money raised without issuing more stock and diluting existing shareholders.
Incredible. So they fund themselves by selling past successes.
Pretty much. They do some targeted in-licensing too, like bringing in that AG-236 drug from Alnylam to complement their internal R&D. But yeah, the big picture shows a management team acting like really shrewd portfolio managers. They monetize one major asset, oncology, to fully fund another, rare diseases, all while protecting shareholder equity.
And that leaves them with how much cash now?
A very robust $1.3 billion cash position. That gives them an extensive operational runway, which, as you said, is just critical. And consistent with being a growth stage biotech focused on reinvestment, they don't pay dividends. No significant share buybacks either. In fact, the buyback yield is negative, around negative 3.9%, but that's mostly due to employee stock compensation, not actual buybacks. All the capital goes right back into the business.
Okay, so what about return on invested capital, ROIC? Is that looking good?
Well, no, not yet. It's currently negative, somewhere between roughly negative 16% and negative 26%.
Negative ROIC. That sounds bad.
It might raise a flag, but you have to put it in context.
Mhm.
This is actually expected for a company like Agios right now. They're in a heavy investment phase. They have to burn cash to fund these crucial, expensive late-stage trials and build out their commercial teams.
So the bet isn't on current returns, it's on the future.
Exactly. The whole investment thesis here is based on the potential for a really attractive future, ROIC, and it's a big if PYRU-QINB succeeds in those multi-billion-dollar thalassemia and sickle cell markets.
Okay, that context is crucial. Let's get into the specific numbers now with Chapter 3, Financial Analysis.
All right, crunching the number.
Market cap first, roughly $2.19 billion. So squarely in that small to mid-cap biotech zone.
Right.
And their revenue growth over the last 5 years really tells that transformation story we talked about. They went from basically zero revenue in 2021
Pre-PYRU-QINB launch, yeah.
to $14 million in 2022. Then $27 million in 2023, $36.5 million in 2024. And the trailing 12 months, as of Q2 2025, hit almost $41 million.
So good percentage growth, but obviously starting from a very small base. It does show promising early signs of uptake for PYRU-QINB in its first indication.
Definitely promising. What about profit margins? This is where it gets interesting, really.
It really does. Okay, so gross margin, that's revenue minus the direct cost of making the drug it's healthy. Yeah. About 75%, which is pretty typical for innovative pharma products.
Okay, good start.
But then operating margin, it takes into account R&D is G&A. It's deeply negative, like minus 11,166% for fiscal year 24, and slightly worse, minus 1,188% for the trailing 12 months.
Wow, so costs are just vastly outweighing sales right now.
Massively. It starkly shows that huge investment spend. But now, here's the kicker, the really fascinating part. Their net profit margin for FY24 was, wait for it, a positive 1,846%.
Hold on, how do you go from minus 1,100% operating margin to plus 1,800% net margin? That doesn't compute.
Exactly. It seems wild, right? But this divergence is so critical to understand. That massive positive net margin has nothing to do with their core operations, with selling PYRU-QINB.
So where's it from?
It's purely an accounting effect from that huge one-time non-operating income, the $1.1 billion they got from selling those oncology assets.
Ah, the Servier royalty pharma money.
That's the one. So the underlying business, the actual operations, still posted a loss of over $425 million. That's why you absolutely cannot look at a price-to-earnings ratio based on that temporary net margin. It's fundamentally misleading about the health of the core business.
Gotcha. That's a huge trap for investors just looking at headline numbers. What about cash flow?
Consistently negative free cash flow, as you'd expect given the operating losses. They're burning through cash somewhere in the range of $300 million to $400 million per year.
Okay, burning cash, but they have that big pile of cash, right?
Exactly. That $1.3 billion cash position we keep mentioning is the safety net. It provides them with a fantastic 3 to 4 year cash runway at current burn rates.
Which is huge in biotech.
It's incredibly valuable. It means they can likely self-fund through these upcoming major milestones, the thalassemia decision, the sickle cell data, without needing to go back to the market for more capital, which would likely be dilutive. That's a rare luxury. And their earnings track record reflects this pattern too. Consistently negative operational earnings, with the only big positive spikes in 2021 and 2024 coming directly from those one-off asset sales.
What do analysts expect going forward? Still losses.
Yep. They expect a return to operational losses. The forecast is for a negative EPS earnings per share of around negative $7.12 for fiscal year 2025 and about negative $6 for 2026. Still burning cash.
Okay, but financially stable overall, like debt levels.
Oh, yeah, their financial stability looks pristine on paper. Debt-to-equity ratio is exceptionally low, just 0.04. They're virtually debt-free.
Wow.
And their current ratio, which measures ability to meet short-term obligations, is incredibly strong, between 13 and 14.5. Overwhelming capacity there. And as we said, never paid a dividend, not expected to anytime soon.
So financially solid balance sheet, lots of cash, but operationally burning money and relying on future drug success. That brings us to valuation. How do you value something like this?
Tricky. Relative valuation metrics, like that trailing PE ratio of around 3.3. As we discussed, it's fundamentally meaningless because of the artificial boost from the one-time income. Forward PE is negative because they're expected to lose money.
So PE is useless here. What else?
You really have to turn to intrinsic valuation methods, like a discounted cash flow or DCF model. That tries to value the company based on its projected future cash flows, discounted back to their present value.
But that sounds really hard for a biotech with so many ifs.
It is inherently complex, especially for biotech, because you have to make huge assumptions about things like trial success, FDA approval, market adoption, competition, all highly uncertain.
Okay, so bearing in mind it's complex and assumption-driven, what does an educational DCF model suggest for Agios?
An educational model, emphasizing those caveats, suggests an intrinsic value range for AGIO somewhere between $45 and $60 per share.
$45 to $60. But that range depends heavily on those assumptions you mentioned.
Absolutely. It's highly sensitive. Key assumptions driving that range include, first, really aggressive revenue growth kicking in after 2026. That's entirely contingent on getting those FDA approvals for both thalassemia and sickle cell disease, and then successfully launching and capturing significant market share, leading to peak annual revenues maybe over $1.5 billion sometime in the early 2030s.
So blockbuster status, basically.
Pretty much. And second, the model uses a high discount rate, 15%. That high rate is chosen specifically to reflect the substantial risks involved. The risk of clinical trial failure, the risk of regulatory rejection by the FDA, and the risk of intense competition, especially from those gene therapies.
Right, a 15% discount rate acknowledges a lot could go wrong. Okay, that gives us a framework for valuation. Now let's gauge the market's mood in Chapter 4, market sentiment.
All right, what's Wall Street saying? Overwhelmingly bullish, actually.
Right, despite the risks.
Yep. The average brokerage recommendation, or ABR, is 1.78. On that scale, 1 is a strong buy, 2 is buy, 3 is hold. So 1.78 is pretty strong.
How many analysts?
Looking at the breakdown, 6 firms rate it either buy or strong buy, 3 have it as a hold, and importantly, 0 analysts rate it a sell.
0 sells, okay, and price targets.
The consensus target price falls in a range of $50 to $57 per share. That suggests, potential upside of roughly 38% to 63% from the current share price, around $37. Individual targets vary quite a bit, though, from a low of $38 to a high of $74.
So analysts are optimistic overall, seeing significant upside potential. How does the stock react to news? Seems sensitive.
Very sensitive. We've seen positive headlines drive it up, like the PYUKYND approval for thalassemia over in Saudi Arabia, or positive data from the Phase 3 Energize trial in thalassemia.
Right.
But it's equally, if not more, sensitive to negative news. We talked about that early August dip when the analyst note about patient deaths came out. It recovered after the company clarified, but it shows the fragility.
And earnings reactions.
Mixed bag. Q2 2025, for instance, they actually beat revenue expectations, which you'd think is good, but they missed on EPS. The loss was bigger than expected, and the stock dipped in pre-market trading.
So the market's watching both things, the revenue growth trajectory and the path towards profitability, or at least managing the cash burn.
Exactly. They want to see that growth, but they're also very focused on the bottom line and the cash situation. And if you want another indicator of market sentiment, look at the short interest. It's pretty significant.
How significant?
About 4.18 million shares are currently sold short. That represents 8.16% of the float the shares actually available for trading.
Over 8% short interest. That's quite high. What does that tell you?
It tells you this is a classic battleground stock.
Yeah.
You've got the bulls focusing on that huge market potential, the first-in-class drug, the strong balance sheet.
And the bears.
The bears are zeroing in on the gene therapy competition, the high cash burn, the lack of current profitability, and the binary risk of these upcoming trial results and FDA decisions. One negative outcome could really hurt the stock.
So lots of disagreement, which means volatility.
High volatility is almost guaranteed, especially leading into and coming out of these major catalysts.
Okay, what about technically? Where's the stock price relative to its moving averages?
Right now, it's trading just slightly above its 50-day moving average, which sits around $35.50. That generally indicates some positive short to medium-term momentum.
Okay, short-term looks okay. Long-term?
It's trading almost exactly at its 200-day moving average, which is around $36.90. That 200-day is a really critical long-term level for technical analysts.
So it's sitting right on a key support resistance line.
Pretty much. It suggests the stock is at an inflection point, really just waiting for direction from these big upcoming catalysts, that PDUFA decision in September or the Phase 3 SCD results later in the year.
Interesting technical picture. Okay, let's pull back the curtain now and look at who actually owns the stock. Chapter 5, ownership structure.
All right. Who holds the shares? Well, mostly institutions. Institutional ownership is exceptionally high.
How high?
93.26% of the shares are held by institutions. That's over 60 million shares held by 258 different institutional holders.
Wow, 93%. Who are the big players?
Top holders include some very big names: Farallon Capital, Vanguard, BlackRock, Bellevue Asset Management, State Street. The usual suspects in institutional ownership.
Are they buying or selling? What's the recent activity like?
It's actually quite mixed. Looking at recent filings, about 112 firms were increasing their positions, but almost exactly the same number, 112, were decreasing their positions.
Perfectly balanced. What does that suggest?
It probably suggests anticipation by some funds who are betting on positive outcomes from the upcoming catalysts, while others might be de-risking, maybe taking some profits, or reducing exposure ahead of those binary events.
Okay, so institutions dominate. What about insiders? Management, board members, are they holding much?
Relatively little, actually. Insider ownership is quite low, only about 1.67%.
1.67%, that's not a lot. And are they buying or selling their own stock?
This is where it gets, well, potentially concerning for the bulls. There's been a consistent and pretty significant pattern of selling by top executives throughout 2025.
Selling? Like who?
The CEO, Brian Goff, he sold over 31,000 shares. The chief medical officer, Sarah Gouins, sold over 22,000 shares. The CFO, chief legal officer, also sellers.
Okay, lots of selling by the top brass, any buying.
And this is the crucial part. There have been zero open market purchases by any insiders over the past 12 months. None.
Zero buys, lots of sells. How should we interpret that? Some sales are planned, right?
That's true. Many of these are likely automatic sells set up under prearranged 10b5-1 trading plans. These plans are designed to let insiders sell stock over time without being accused of trading on non-public information, so you can't read too much into individual sales.
That's the pattern.
But the overall pattern, the complete lack of any buying, especially when combined with consistent selling across the executive team, well, it can certainly be interpreted as a soft negative signal. It suggests that management, the people who know the company best, don't seem to view the current stock price around $37 as significantly undervalued. If they did, you might expect to see at least some buying.
Yeah, that lack of buying is telling. Okay, so high institutional ownership, low insider ownership with lots of selling. Does the concentration matter?
It does. That high concentration of ownership among just a few top institutional holders means that decisions made by those large funds, if they decide to buy more or sell off a big chunk, can have a really significant influence on the stock price. Yeah. It adds another layer of potential volatility, especially around news events.
Makes sense. Okay, every deep dive has to confront the challenges directly. Let's unpack all the potential downsides in Chapter 6. Risk assessment. We can use a SWOT analysis framework: strengths, weaknesses, opportunities, threats. Let's start with strengths.
Sounds good.
So strength number one has to be that exceptional financial position, right? Over $1.3 billion in cash, virtually no debt, that long operational runway we talked about. Huge strength.
Absolutely fundamental.
Second, their deep scientific expertise. They are world-class leaders in understanding cellular metabolism and specifically PK activation. It's a core competency.
A real scientific moat, as the report called it.
Third, that first-mover advantage. Being the first FDA-approved therapy for PK deficiency gives them credibility, data, and relationships.
Established presence. Yep.
And finally, a clear strategic focus. That pivot to being a pure play on rare hematologic diseases provides clarity and direction. No distractions from oncology anymore.
Okay, moving to weaknesses. The most obvious one is single product dependency. Right now, and for the near future, the company's fate rests almost entirely on the success of PYUKIND and these new, bigger indications.
All eggs in one basket, basically.
Pretty much. Second weakness, the high cash burn rate. As we saw, they're operationally unprofitable, burning through hundreds of millions each year to fund development and prepare for launch. That can't go on forever without success.
Right, the clock is ticking, even with the big cash pile.
And tied to that is the lack of core profitability. We have to keep stressing this. The positive net income seen recently was not from sustainable operations. It was from those one-time asset sales. The underlying business isn't profitable yet.
Okay, on to opportunities. The biggest one, clearly, is major label expansion. The opportunity to expand PYUKIND into those multi-billion-dollar markets for thalassemia and especially sickle cell disease is transformative potential.
That's the whole ballgame, really.
Second, there's pipeline advancement. They are developing next-generation assets like tebapivat, which could provide future revenue streams beyond PYUKIND.
Building for the longer term.
And third, strategic partnerships in M&A. With their strong cash position, focused expertise, and potentially valuable drug, they could be an attractive partner for a larger pharma company or even an acquisition target down the line.
All right, now for the threats. And these are significant. Top of the list. Intense and disruptive competition. It's a dual threat, really. You have direct competition from other PK activators like etavopivat.
The Novo Nordisk drug.
Right. And maybe more existentially, you have the threat from those potentially curative gene therapies, Zynteglo, Casgevy. They could fundamentally change the treatment landscape and shrink the market for chronic therapies like Pyruvate.
The pill versus cure dilemma again.
Exactly. Second major threat, clinical and regulatory failure. There's always a significant risk that these pivotal phase 3 trials could fail to meet their endpoints, or that the FDA could reject the drug for these new indications. That's the binary risk inherent in biotech.
Huge risk.
And third, even if they get approved, they face pricing and reimbursement hurdles. Getting favorable pricing and securing reimbursement from insurers can be challenging, especially when there are competing options available or coming soon.
Those are company-specific threats. What about bigger picture, macroeconomic stuff?
Good point. Macro threats are real too. First, the cost of future capital. If for some reason their cash runway isn't long enough or they want to do a big acquisition, high interest rates make any future financing much more expensive than it was a few years ago.
Right, borrowing money is costly now.
Higher rates can also dampen the overall M&A environment. It can slow down industry consolidation, potentially reducing the chances of an attractive acquisition exit for Agios.
Makes sense. And inflation.
Inflationary pressures directly impact them too. They increase the cost of everything, R&D supplies, running clinical trials, employee compensation. That just accelerates the cash burn. And one more external factor to consider, geopolitical risks. Specifically, the report mentions the potential impact of proposed 2025 U.S. tariffs.
Tariffs on what?
Potentially on things like pharmaceutical raw materials, lab equipment, manufacturing machinery. If significant tariffs, say 15–25%, are imposed, that could disrupt their supply chains and directly increase their cost of goods sold and their R&D expenses, another pressure point on costs.
Okay, lots to worry about there. So after digging through all of that, let's try to bring it all together. We're at Chapter 7, conclusion. Let's synthesize the bull case first. What's the optimistic view?
Okay, the bull case boils down to this. You have a financially robust, pure-play specialist in rare diseases. They've got a first-in-class oral drug, PYRUKYND, that's already proven itself in one indication and is now on the verge of potentially major catalysts. That PDUFA decision for thalassemia is just weeks away, and crucial phase 3 data for the huge sickle cell market is due by year-end.
Catalysts that could unlock multi-billion-dollar markets.
Exactly. They're guided by an experienced management team with specific rare disease commercialization chops. And critically, they offer that compelling oral convenience advantage over the complex, risky, and expensive gene therapies. That convenience could be a deciding factor for many patients and doctors.
Okay, compelling bull case. Now, hit me with the bear case. Why might this not work out?
The bear case counters with some pretty hefty risks. First, that single drug dependency we keep mentioning. It's all riding on Pyruvate for now. Second, formidable and diverse competition, especially those gene therapies that offer the potential for a cure that's a powerful narrative to compete against. And they could genuinely shrink the addressable market for a chronic treatment, like Pyruvate over time.
Right, the market size itself might not be as big if cures become common.
Precisely. Third, the deeply unprofitable core business. We can't forget that the recent profits were artificial, driven by one-time sales. The underlying operations are still burning significant cash. And finally, that pattern of continuous insider selling with zero insider buying. It just acts as this soft negative signal, making you wonder why management isn't buying if the stock is supposedly undervalued.
So, bulls see blockbuster potential inconvenience, bears see competition, cash burn, and questionable insider signals. Where does that leave valuation? Remind us of the DCF range.
Right, that educational DCF model, which, remember, assumes successful execution on those approvals and launches, suggested an intrinsic value range of $45 to $60 per share.
Okay, $45 to $60 intrinsic value, assuming things go well, and the stock is currently trading around $37.
Exactly. So the current share price of about $37.06 is sitting noticeably below that estimated intrinsic value range.
What does that gap tell you?
It clearly indicates that the market is pricing in a significant degree of risk. Investors are discounting the potential rewards because of the uncertainty surrounding those upcoming clinical results and regulatory decisions. They're not giving Agios full credit for success yet.
So the bottom line?
The bottom line is that Agios Pharmaceuticals is a classic high-risk, high-reward proposition. It really is. The investment outcome here hinges almost entirely on their execution and, more immediately, on the results of these key catalysts over the next, say, 12 to 18 months. It's a story that's about to reach some critical plot points.
A high-risk, High reward proposition indeed. Well, that was a truly deep dive into Agios Pharmaceuticals. We really hope this has given you that shortcut we promised, helping you feel incredibly well informed on this fascinating and complex company.
Hope it was useful.
And now, just a quick word from our partner for this deep dive. Please make sure you like this video and subscribe to the Stock Analytics AI YouTube channel. It really helps us out. And remember, for just $4.99 a month, members get priority deep dives on the tickers you want to see. We're planning to cover all of the S&P 500 stocks over the next few months, and members get exclusive priority access to those requests.
And if you just want a one-off deep dive on a specific stock you're interested in, you can always drop us a super thanks right here on the video.
Great way to support the channel and get the analysis you need.
And as always, please remember that this analysis was generated by an AI system. It's intended for educational purposes only and should absolutely not be considered financial advice. Always do your own research, conduct your own due diligence, or consult with a qualified financial advisor before making any investment decisions.
Absolutely crucial. Okay, one final thought to leave you with. Considering these rapid advances we're seeing in gene therapy, offering potential cures, and contrasting that with the sheer convenience of an oral pill like PYR-UCAN-OD, how do you weigh the value of a potential one-time cure versus a lifelong, but maybe easy-to-manage treatment for these devastating rare diseases? It's a really fundamental question, not just for investors trying to value companies like Agios, but really for the entire future of medicine itself, something to think about.